And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's Wednesday. It's hump day. Thank goodness. More earnings out this morning. Bank of America reporting earnings this morning, beating earnings on trading revenue. And again, if you don't understand what that means, that's their proprietary trading desk where they are basically moving markets and making money for themselves. Johnson & Johnson also reporting earnings this morning, beating estimates by a decent amount. What's interesting with the banks, though, is that revenue growth has been very weak. So despite the fact they're beating earnings, revenue growth really isn't there. In fact, revenue growth for Bank of America was less than expected, while earnings were better than expected. So again, that goes back into the whole story about share buybacks, which, as we noted this morning in our daily market trading update, is that buybacks have now surged to a record high. We're on pace for exceeding $1 trillion in buybacks this year. So again, that whole support for the market continues to be there. Having said that, we are now fully into the blackout window for the next 3 weeks. So for the next 3 weeks, most companies are in blackout from buybacks. So again, as you saw yesterday, markets kind of struggled around most of the days and kind of sold off in the afternoon. But again, that's just kind of where we are. So we're getting some of that kind of weakness right now. But again, we're still right in the heart here of earnings season. So we're going to be paying attention to that a lot more closely here over the next few days. The other interesting report yesterday, this morning we're going to have the Producer Price Index report. Yesterday we had CPI. What was interesting about the CPI report yesterday is there was something in it for everybody. For just people watching CPI did rise because of very weak year-over-year comparisons. That's not surprising. That happens. Inflation's been falling, so you're now getting these comparisons to year-ago levels where they were very weak. So any little minor change creates an uptick in the rate of inflation. But it was very minor. Overall, headline inflation came in as expected. Actually, the core came in weaker than expected. So again, kind of on the surface, the tariff impact is still not showing up. This is the 5th month in a row it hasn't done that. But for those individuals who are looking for the tariff impact, if you dig down really into the report, and this is like everything, right? If I really want to find something wrong with something, if I just keep digging, I'm going to find something, right? I can find a reason why a stock or whatever is a bad investment. If I just dig enough, I can come up with a reason. Same thing with CPI yesterday. For those that are just bent on tariffs going to cause inflation. If you really dig down, yes, there was some inflation in appliances. But here's the thing about that. As we said before, yes, there are certain items that are going to be impacted by tariffs because they are, manufactured overseas, brought into the country. We buy it directly from a country that's being tariffed. Yes, that tariff is going to show up in that good. How many people bought appliances last week, right? And if you bought appliances last week, did you buy appliances the week before? The point is that, yes, we buy appliances and we pay more for them, but as consumers, if I'm going to go buy a new washer or a dryer, whatever it is, and that cost has gone up dramatically, I might say, hey, you know what, I'm going to fix the old one because it's cheaper and I'll just keep it for now. Or, you know what, my old one's still working just fine. I'm just going to hold it on, kind of hold on to it for right now, and maybe I'll buy an appliance later. Or, I go ahead and buy the appliance, but I buy appliance once and then I don't buy that again for several years. So that's not a major impact to the consumption of consumers because these are very one-off purchases. But overall, foods, appliances, transportation, housing, the big contributor to yesterday's tick in inflation was housing, which rose by about 0.2%. That's 40% of the index. So there was a little uptick in the housing homeowners equivalent index. But again, that data lags by about 3 to 6 months. So, if you take a look at real-time rent indexes, et cetera, those are all negative. So that downward pressure in CPI from housing is still coming. Again, that's 40% of the index. So, you can have 5 or 10% of the index doing whatever it wants, when you got 40% of that index weighing down, it's really hard to offset that. So again, the overall drive for inflation in terms of what the market cares about, and again, let's be very clear about this. We're talking about what the market cares about. And what the market cares about is headline inflation on CPI, PPI, and how that feeds through to PCE. That's what the market cares about. Now, your personal issues over inflation, those are yours, right? But the market, our trading, our investing, our money management only cares about what the headline report is. And that is still very much in line with Fed policy. Now, the change in inflation yesterday is going to probably keep the Fed on hold, at least temporarily, through this next meeting. So again, we probably are not going to see rate cuts at the July meeting. It'll probably be the September meeting that we see the first set of rate cuts. But again, we'll keep a watch on that. Speaking of rate cuts, let's talk about what you need to know before the bell this morning. Market is doing what the market does best right now. Is after having a big run, it's just been here consolidating as of late. And one of the things that, again, that we've kind of been watching is that we do have this very elevated kind of momentum signal. It's just kind of flipping back and forth. Now, that's not uncommon for that signal just to kind of get hung up and just kind of trade sideways for a while as kind of underlying momentum deteriorates in the market. And we are seeing that relative strength is coming down here a bit from overbought condition. That's keeping the market really from making much of an advance. We've just kind of been stuck here for the last week or so, kind of trading back and forth. That's, one of the issues kind of hanging over the markets, particularly as we're going in earnings season. The other is just simply this it's kind of back and forth debate over Fed rate cuts. Again, what the market keeps kind of hoping for is the Fed's going to cut rates, and when we get kind of get this idea the Fed's about to cut rates, the markets rally a bit on that, more accommodation. When data comes in like yesterday and potentially with PPI today, we'll see what the producer price index says. But if there's an uptick in inflation on the producer side, now if tariffs are going to show up anywhere, it's going to show up on the producer price index side, because those are the people that actually pay tariffs. But if that comes in a little bit hotter than expected, that's going to probably weigh on the markets here a little bit more. So that report comes out at 7:30 this morning. So again, we're kind of just waiting for that to come out. But that could weigh on the markets here temporarily. But again, markets just kind of consolidating here, working off some of that overbought condition. We saw this just previously. We kind of got overbought here, worked off a little bit of condition, kind of consolidated a bit, then you had the next leg up in the rally. That's kind of the stair type rally here is kind of what we should expect here over the next month. Now, again, this doesn't mitigate the risk that we're not going to have a 3 to 5% correction probably in August or September. We're getting set up for that. Bullish exuberance by asset managers has had a huge surge. One of the things that was a good propellant for the markets here from these recent lows was the fact that most fund managers were very underweight tech. They had sold off tech going through this Liberation Day event. They had gotten very underweight, very short technology. Coming out of this, they had to get repositioned, and they lagged that. They lagged getting back into the technology stocks during that most of that advance, and here just lately, all of a sudden, they have just come back in force, and we've had a huge surge in both positioning and bullish sentiment on technology. But again, that level of professional investor sentiment is now at levels that normally coincide with at least short-term market peaks. Again, remember, sentiment is a contrarian indicator, so when you have everybody very bullish, everybody that's bought has already bought, right? So that leaves kind of a vacuum pocket underneath stocks for where the next set of buyers are on a correction. So again, we're getting bullish sentiment, positioning, etc. on both retail and professionals back to more extreme greed levels. So, we just kind of keep talking about here lately, just take little profits, rebalance, those type of things, just be cautious. I think we're going to get a 3 to 5% correction sometime between August, September, somewhere in that range would seem kind of likely, set us up for that year-end rally from October through December. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff. Got some stuff to get into with him this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, Danny Ratliff joining me this morning. Good morning, sir. How are you?
Hey, good morning. Great.
Good. Got a few things to get into. I want to show you this chart, though, real quick, Danny, just to kind of get your take on it. So, there's been a lot of debate about Jerome Powell here as of late, and kind of this spat going on back and forth between Jerome Powell and President Trump. And this isn't new, by the way. If you go back to 2018, we went through this exact same thing, but this is the odds right now, the betting odds that Trump will remove Powell in 2025, and the kind of the bet is that that'll happen before September. So this is all kind of starting to heat up now. But again, this is not any different. This spat is no different than what we saw back in 2018. If you remember back in 2018, and we were going into, Trump had started a trade war with China back in January of 2018, put tariffs on China, had this whole trade spat going on with China. At the same time, the Fed was hiking rates at the time, and we were going into the September Fed meeting, and markets are doing okay. They're been a bit volatile, but they're not doing anything dramatic. And Jerome Powell states that, we're nowhere near the neutral rate. In other words, the Fed needed to keep hiking rates to get the Fed interest rate to where it was supposed to be relative to economic growth. And of course, that sparked a 20% decline. Immediately following that, Jerome Powell and President Trump are at each other's, kind of throats. He's threatening to fire Powell, et cetera. And then nothing ever happened. And by June of next year, Trump was right in the fact that he should have been cutting rates. And by June of 2019, he was cutting rates because we were running into a repo crisis. And we had this massive, collateral issue going on with the Fed. And of course, then by February of 2020, we're at zero interest, or March of 2020, sorry, we're at zero interest rates because of the pandemic. So we've seen this story play out before. So it's just kind of interesting, though. The betting odds are really starting to bet here that Trump's going to fire Powell. I don't think I may be wrong, right? Trump would certainly love to have somebody else in there, but unless he can find the president really can't fire President Trump. President Trump can't fire Powell. I'll get this out in a second, without cause. And for right now, I just don't really see any issue for cause.
Well, I think the cause
just not cutting rates is not cause.
Well, I think that's going to be essentially Powell's scapegoat, is that inflation is transitory. And clearly we're seeing that, right? And so how can you dictate what's happening, especially when they're looking at data that's in the past? But, now the new talk is, CPI was a bit higher. What's PPI going to be this morning?
Right.
And so, granted, it was a bit higher. And we've been talking about how we think we could see it. And, you get a little bit of inflation here and there, and then, kind of dwindles back down.
Mm-hmm.
And
but just year-over-year comparisons, I was saying this morning, we'll do that for you.
Yeah, exactly. And so that's where I think that President Trump's going to have a difficult time.
Yeah. Well, and again, look, the bigger issue, I think, really, too, is what the markets want. And let's forget about everything else for a second, because all we care about as investors is what does the market want. And what the market likes is at least the idea. And look, I think there's plenty of evidence out there that the Federal Reserve is not completely independent. We've seen actions taken by the Fed as long as I can remember, going back to back in 1932, when we were trading markets and the Fed was just getting on its feet. But since then, we've seen plenty of times in history where it would appear that there is a support of the Fed to the presidential policy, right? Back when Volcker and Reagan were even working together, you could say, well, there was some political influence there because they were trying to break the back of inflation. So they were working together, but there's always been this idea that the Fed is completely independent. I think there's some evidence that no, they're not completely independent, but Wall Street wants the appearance, at least, that the Fed is independent and making its own decisions based on the data, et cetera, and really just kind of making its decisions for the benefit of the banks, who are their members of the Fed. So, I think, the one thing that the markets may not like is if the president does actually fire Trump, I'm not sure the markets are going to respond positively to that action, because now it's going to appear that whoever takes Powell's place is going to basically be the puppet of the president and not an independent, kind of validator of the economy.
Yeah, but, he did put Powell in his place initially, right?
He did. He nominated him. And
clearly, with the exception of maybe 2019 and him really getting on him at the time, and markets hated that. So going back to what markets really wanted, in October of 18, when he said, hey, we're a long ways from neutral, we're going to start increasing rates. I mean, we saw one of the worst fourth quarters since, the Great Depression?
Yeah, it was down 20% a quarter.
Basically erased a really good year in markets. And so that, I think, is going to be where the struggle comes in when it comes to this. And, he has remained relatively independent from the president for the most part. Mm-hmm. And, that's going to be where, he's going to put somebody else in. Is he going to be a yes man or is he not? And I think that, we've even seen that with some of the Supreme Court nominees that he's had.
Yeah, well, Justice Roberts would be a good example.
Yeah, and what was the last one? Amy
Cody Barrett.
There you go.
Yep. But yeah, no, this is kind of the point, though, to kind of watch is that, this is not, for the market, I would not completely dismiss the SPAC going on, because I do think there's going to potentially be an impact from this when it occurs. Now, stepping back from this, should the Fed be cutting rates? Absolutely. There's plenty of economic evidence that the economy is slowing down. And I've said this before, is like, if the Fed is cutting rates slowly, just a quarter basis point here, a quarter basis point there, the markets are okay with that. The markets will actually hold up well in that environment. What markets don't like is when the Fed cuts by 50 basis points. And because that is that kind of wake up aha moment where they go, well, why are you cutting 50 basis points? The economic data must be a lot worse than what I think it is. And I'm going to have to start readjusting valuations for what I'm paying for earnings. And all of a sudden, that's where markets kind of go upheaval at that point, and we see these kind of bigger declines in markets. So, I think the Fed is kind of boxing themselves in. If you take a look at the solely the economic data and look at some of the kind of mainstream economic data. We're clearly showing weakness in the economy. We're clearly showing the consumer under stress. And the problem for the Fed is always the case is they're kind of working on lagging data. And by the time it shows up, I think they're going to be too late cutting rates. I do think Trump is right that Powell is going to be late on cutting rates here, probably sooner than later.
He's been late on everything. I mean, that's not a real...
But not just Powell. Bernanke.
In all fairness.
Yeah, Ben Bernanke, 2007, subprime is contained. We're hiking rates. Everything is fine. Don't worry about it. Alan Greenspan, 1998, there's inflation coming and, not paying attention to what's happening in the underlying markets and ran us right to the dot-com crash. So yeah, and they're late. They're late reversing that coming out of the issues as well. Powell should have been hiking interest rates and cutting QT by the third quarter of 2020 rather than running that all the way through 2023.
Well, let's talk about how they get the data most of the time anyways.
Yeah,
that initial data is coming from economists that are polling. They're polling essentially, right?
Yeah.
And then they revise that data and they say, oh, shoot, we probably should have been doing this already, or we were in that recession, or we were in this environment. And so that, I think, is the struggle that they are faced with. And I don't envy their position as Fed chair, right? You have a lot of things that you're controlling here. But I agree. I think that, if we see a larger cut, that's typically when the market says, oh, shoot, what is happening? And, it's not typically the environment that many think we're going to get when they begin cutting rates. But do you see them cutting here the next Fed meeting?
Not the next meeting.
Yeah.
Two things will depend on that.
The markets are not betting on that.
Right. No, the markets aren't betting on that. But again, the inflation data is still, a little bit higher than they would like. Right. It's not going up. Tariffs are not showing up in the CPI report, other than in very one-off things. Like I said this morning, there's a big jump in appliances, right? But how often do you buy appliances? So we're seeing it in those areas. But I think today's PPI report will be very important. If tariffs are going to show up, it's going to show up in the PPI report because, as we've talked about before here on the show, producers are the ones that pay the tariff, right? So if I'm manufacturing something, I'm going to pay the tariff and I have to pass it on. And this is also a really important statement. Producers pay tariffs because if I'm producing something, I'm buying some type of commodity, et cetera, to build something, manufacture something, whatever it is, to sell. I'm building an appliance. I'm building a washer or dryer, whatever it is. That is only 20% of the economy now. Back in the 70s and early 80s, manufacturing was 80% of the economy. Services are 80% of the economy today. You don't tariff services, right? You don't really import a service from China or India, wherever else. Most services, delivery drivers, et cetera, those are not tariffed. So one of the reasons that tariffs have been defying economists and not showing up in the economy is that a big bulk of the activity in the economy today is tariffs. Give you a good example of this. I saw a stat this morning. It was pretty amazing. Of all restaurant food sales, Danny, quick, because we're coming up on a break, what percentage do you think are in restaurant dining?
Ooh.
I said quick.
65%.
You would be incorrect. 25% of restaurant sales are in restaurant eating. 75% are delivery.
Wow.
And this is why nobody has any money, by the way, because you spend it all
DoorDash,
on delivery
Uber
fees.
Eats.
Exactly.
Yeah.
You're spending all your money on service delivery fees. That's why you have no money to invest. So stop it. As Danny calls it, leakage. You have leakage. All right, be right back after the break. We're talking about SPACs are back. What does that mean for the markets? Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Last night I got home and my wife was all excited. I went to ChatGPT and I've laid out a whole business plan for a coffee shop. I'm like, oh God.
The Real Investment Show podcast.
Well, long time she's wanted to have her own bakery and I've been slowly encouraging her not to.
Same show, your schedule.
So I may be in the coffee shop business here soon, so I may need your help to support my wife.
The Real Investment Coffee Shop.
Exactly.
I like it. It's got a nice ring
the
to
sound of that.
Exactly.
We'll have a couple soapboxes in the corner. We can stand up and we can put them to sleep with economics. Then they need more coffee, and then we'll go through. We'll sell so
Brilliant.
much.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So as I've told you before, the one thing that you can count on with Wall Street, and this is always the important thing to remember when you're investing, is that Wall Street is a business. And when anybody's telling you something, right? You need to buy this, you need to buy that. They're not giving you advice. They're selling you something. They're selling you something. And this is how Wall Street works. At least Wall Street was honest back in the 80s, right? Because everybody worked on commission. And you knew when your stockbroker called you that he was calling you to give you, a recommendation to buy some stock or whatever it was. And you knew you would pay commission for it. And at least it was a fair transaction. And you said, okay, well, yes or no. And if you said no, you didn't buy it and you didn't pay the commission, it was fine. But at least it was clear, open, and transparent. And that has been convoluted in recent years because of ETFs and SPACs and all these other things. And it was interesting because, we've talked about before on the show is that when there's a lot of demand by buyers for products or investments of some sort, Wall Street is more than happy to meet the need. It doesn't necessarily mean they will bring you a good product to meet that need, but if you've got demand for something, they will certainly bring you product to meet it. So if you're demanding 2x leveraged ETFs or whatever it is, they are more than happy to provide you 2x, 3x, 4x, whatever they can figure it out. If there's a demand there where they can make money, they're gonna do that. And we saw this in particular back in 2021 after, if you remember, after we talked about this on the show a lot, I wrote several articles about this. But in 2021 and really, kind of early 2022 even, there was so much demand for speculative investments that they could not get IPOs to market fast enough of new companies, because IPOs take a while to do. I mean, you got to find a company, you've got to, meet listing requirements for the exchanges, you got to get them listed, it takes time, right? So IPOs were coming to market pretty readily. There was a pretty good flow of IPOs coming into the markets in 2021, but there was so much demand for risk assets that Wall Street said, oh, well, here's what we'll do. We'll create these special purpose acquisition companies, which were these shell companies that were publicly listed. And then they say, okay, you give me money. And then once you give me money, I'll go out and find a deal to invest in. And we'll do this. And we saw this with electric car companies, and we saw with a whole lot of things. And the results were absolutely, unsurprisingly, disastrous. A lot of these companies went bankrupt. They failed to make. I mean, when you had, it's not Aaron Hernandez? No, not Aaron Hernandez. The baseball player that came out with a SPAC.
Aaron Rodriguez.
Thank you. Aaron Rodriguez. Thank you.
Well, you've had Shaq. You've had a number of celebrities and athletes that are coming out with SPACs, and it's the hot thing.
Well, right. And if I can get a celebrity to promote my SPAC, right? It's kind of like getting Ryan Reynolds to promote your mobile company. So, gets people to go invest in the SPAC. Oh, if Shaq's behind this, I'm going to put some money into it.
Yeah.
But, it's interesting. And of course, the fallout from that was absolutely disastrous in 2022. Investors lost a tremendous amount of money in a lot of these companies, if not all of their money. A lot of these went completely bankrupt. But it's interesting because it's, here we are just 3 years post that fact, and already we're now seeing this demand for SPACs coming back in the markets. Why? Because we can't get IPOs to market fast enough to meet all your investing needs. There's such a demand by retail investors for more speculative type investments that we're now moving back into SPACs. In fact, 71 SPACs have already come to the market this year. And that's a volume that's on track to surpass the full calendar year from what we saw previously. So again, if SPACs keep coming to market as fast as they are right now, we're just kind of repeating that whole same process. And at the same time, the IPO market for the U.S. is heating back up as well. I mean, we've seen recent IPOs come to market. But again, that's that speculative demand. And Brent, I want to share a chart real quick here. But that's that speculative demand returning to the markets. But it's not just from retail investors. It's also from professionals. We've seen the biggest net change. And I talked about this during the opening segment, but here's the chart that goes with it. This is the biggest net change since March of 2009 for investors to get into being overweight technology stocks. So there's and this is professional investors. Retail investors are already ahead of the curve. Remember, retail investors were buying heavily back in April and May. They've already been buying and front running this whole market, and then this has pulled all the professional investors back in. So now we've got extremely bullish sentiment and positioning on both retail investor side. That's the demand side of the equation. And now Wall Street's got to fill it, and they can't fill it with normal products, so they're having to bring SPACs back to do it.
Well, think about the beauty of this. They don't have to name the specific company that they're going out and trying to purchase.
Right.
So you're giving somebody a blank check, essentially. These special purpose acquisition companies, that's what's interesting. Special purpose acquisition companies. Well, how special are they if you don't know what you're going after? Mm-hmm. And if you look at it by industry, what do you think the top industry for SPACs are right now?
Cryptocurrency, AI, technology.
It's actually in 2025, it's healthcare.
Really? For SPACs? Interesting.
Yeah, healthcare is 26%, tech is 15%, energy is actually 19% this year, industrial is 15%. So yeah, kind of interesting. And you see that change year by year if you actually go back. There's times, obviously in 2022, it was specifically 50% in financials, 50% in probably more fintech at that time, and then 50% in technology. And you see that kind of ebb and flow. After 22, what happened? Tech got beat up, down 31, 32% in NASDAQ. It was only 10% of SPACs in 23. and then now you've seen it steadily increase again.
Yeah.
But this year it's actually gone down, and I wonder if it's because of the big run that we've seen within
be.
that Mag 7.
Yeah, it could be. But we've seen a lot of IPOs this year and late last year and this year, CoreWeave and others. So we've seen a lot of tech IPOs actually come to markets already. So maybe and again, Wall Street's is running as fast as they can right now to get IPOs to market. But I think the real statement about this is one. It's interesting because they go, well, it's not the same as it was last time because we're not seeing the same levels of frothiness. Well, you're just not seeing the same levels of frothiness yet, right?
That's right.
But again, I think the message here is that we want to pay attention to this from the standpoint that what this suggests is that investors are all in. And the greed levels are getting back to more egregious levels to where that sets the market up for a correction of some sort. And eventually, the problem is always the case, and this is always the kind of the bad side of the story, is that most of these investments are being chased by younger investors. And these are not your seasoned investors buying these SPACs for the most part. These are your younger retail investors that are kind of speculating in the markets. And as we saw in 2022, the average S&P fund or, kind of professional manager was down anywhere from 19 to 23%. The average retail investor was down anywhere from 35 to 60%.
Because they're much more aggressive
because
on their
they were so
own.
aggressive and they were buying a lot of these type of investments in cryptocurrency and these type of things that went belly up. So again, just the message here is that this isn't a message that, oh my gosh, the market's going to crash now because SPACs are back. But this is one of those kind of warning signs that just suggests, hey, you might want to be a little bit more cautious about the risk levels that you're taking in your portfolio, and particularly understand, as is always the case, what you're investing in. And I'm not saying you shouldn't buy a SPAC, but you really need to understand what it is and what its potential is to be a real company. Because if it was a real company, it would just IPO.
Well, and it's very interesting the point you just brought up about, the investor sentiment in general. And, going back through the numbers, it makes a lot of sense. In fact, if you go all the way back to 2003 when SPACs first started coming out, you saw a significant run up, and even with IPOs in general in 2007. And, 2021, we had 610 SPACs.
Yep.
And we've already outpaced last year. Last year was 57.
Right.
So we saw that demand drop quickly. 22 was 86. After that, everybody said, whoa, I think I'm not doing much here, right? And so you had 31, and now we're steadily seeing that increase. We're not still at that probably overly exuberant number, but that's probably a good indicator that, hey, things are changing. The sentiment, which, hey, that could be very bullish for a while, is good.
Yeah. And I guess the question, and I do not know the answer to this, so if somebody in chat actually has the answer to this, I'd like to know, is there any SPAC that has turned into a real company since we've done this? And I don't know the answer to that. I don't know of any SPACs that have become like really important, solid functioning companies in the financial market. And there may be, I'm not saying there's not. I just don't know of any off the top of my head.
Yeah, no, there have been. And so they call that de-SPACing. So, I found some information.
If you spackle or de-spackle, that's the question.
Well, that de-SPAC transition occurs once the deal is announced between a SPAC and a private company. So de-SPAC returns better reflect the business's actual performance instead of market sentiment and speculation.
No, I get that. But
if you look at these returns, is there one that's still here and viable?
Yeah.
And I'm sure, but
that's what I'm saying. Somebody in chat said Neo.
Okay.
So, that's one. Yeah, they are still around.
But if you look at the returns on aggregate, they don't look all that hot.
No, they're not.
Because you have to think so many of them don't do well or don't come to market.
Well, that's what I'm saying. If it was a really good company with a really good prospect,
you just IPO it.
CoreWeave, you IPO it.
Yeah.
Right? So I think that's the other takeaway from that. All right, we'll come back, finish up the show. We want to talk a little bit about something. I had a topic here. I've lost myself. I've lost my topic.
I'll tell you what I want to talk about. Roth conversions and the
No.
New tax law. This is important.
All right, we'll talk about that. Oh, influencers and the hype.
That's boring. We'll talk about it next week.
All right, be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I asked for you to put in the chat if you know of any successful SPACs. That would be cool because I don't know of any. All right, if the SPAC went public and is now $3 a share, that's not successful. I'm talking about one that went public and has increased in value over time because the company's operating. A lot of the Virgin Galactic ain't it. So anyway. Nice try. So, Danny, there are some tax. Big Beautiful Bill passed. Of course, we've talked about this before. It's made some changes, and one of the changes that it provided for was for Roth conversions.
Well, it didn't really change anything on the Roth conversion perspective, but it changed some things that we need to be thinking about and taking into account. And so there is a guy that actually, Ed Slott, he's the IRA guru. We are actually going to have him at our economic summit in January. So we don't have that up quite yet, but that'll be up shortly for you guys to sign up. That will be an in-person event. This guy is the kind of the man when it comes to IRAs and conversions. And one of the things he says is Roth conversions should be accelerated to take advantage of more years of low taxes. So the one thing that we just had occur with the Big Beautiful Bill, probably the thing that is on most people's minds is the impact on taxes. So making this tax code permanent, standard deductions, but it also gives the capital gains are there as well. And we see the SALT taxes increased. But there are some kind of earmarks that we have to be cautious of. So while everybody thinks, oh, great, we can go do a big Roth conversion now, or, really in my mind, I would think that we wouldn't want to go do one big Roth conversion. We want to be very strategic about it and do a little bit at a time over the next coming years versus had we seen an environment where taxes are increasing next year and this tax code sunsets. So one of the things we always talk about is we don't want to leave any tax bracket unfilled. However, we need to be careful now because there are some new instances. So for instance, if you're over 65, you get an additional $6,000 deduction, but that does phase out for income. If you are I can't even talk, an individual, it's going to be $75,000 in income. If you're married filing jointly, it's going to be $150,000. So something that needs to be considered, is that $6,000 deduction worth it? or do you go ahead and go above those numbers if you're doing a conversion based on where your income is today? Another larger benefit is with the SALT tax. That was previously at $10,000. Now that's all the way up to $40,000. However, it begins to phase out at $500,000. You get above $600,000, it goes back to the initial $10,000, and therefore, really, you're essentially losing a $30,000 deduction. Those are probably the bigger ones that I think are on most people's minds, and I think they need to be considered when doing a conversion. And I don't know many people, Lance, that are going out and saying, "Hey, let's go do a $2 or $3 or $4 or $500,000 conversion." They're out there, and they are doing it strategically over time, but occasionally we get somebody who says, "Hey, I'm going to do the whole thing and just be done with it." I would encourage you, unless you're on your deathbed or you think your kids are in a much higher tax bracket, do it strategically. Make sure that your advisor knows about these additional kind of nuances with this, where you could end up hindering yourself in some ways. So now that this is permanent, we have that kind of runway where we can do a little bit at a time each year, be much more surgical with these conversions. And I think it's going to benefit you and your heirs for a much longer period of time, right? When we think about Roth conversions, those Roth funds, we're not initially going to use them. We're going to let them grow over time. And if you have a legacy intent, that's probably the best account you can give your kids, because those funds are going to continue to grow tax-free. But that's really the main thing on that, Lance.
Okay.
Yep. That's it.
That was so exciting.
Oh. If I'm not a bully, but if you were like a kid, I'd go give you like a swirly.
A swirly?
Yeah.
Not a wedgie?
I mean, you'd have gotten that on the way to get the swirly.
There's the back in the day when, it's so funny today, that when I look at kids and stuff and they're out playing and somebody gets pushed down, there's all this, calamity, parents get involved. It's drama. And, just when you bring that up, it just brings back all these childhood memories. It's like you get in fights behind the school, somebody's punching somebody else in the nose, there's blood everywhere, and the kid goes home, is like, "What happened?" "Well, I got punched in the nose." "Would you punch him back?"
That's the first question. Yeah. All right. Well, no big deal. Now you're worried about getting shot, or kids are worried about, stupid
stuff.
That,
or you hook their belt loop up to the flagpole.
Yeah.
What's about the flagpole?
When you talked about memories, I was just envisioning you thinking about all the times you were stuffed in your locker, the swirlies you used to get.
No, I was the one stuffing usually. So I was a bully in intermediate school.
Okay.
Not really. No, I wasn't.
I thought you were.
My dad. If I was a bully at school, my dad would have beat me.
Yeah. No, for sure.
That's the one thing. That's back in the day too, when parents beat their kids on a regular basis.
They minded.
Yeah, they minded.
Well, and
didn't have all this other stuff going on.
But it's a big difference. And, now it's funny. Like I tell the kids, like, hey, you can always protect yourself. Mm-hmm. And, they're so worried about getting in trouble. And I'm like, that kid hit you? You didn't do anything? Like, what's wrong with you?
Yeah. Well, no, I told my son.
If you start a fight and you're a bully, we got a problem.
Yeah. No, I always told my son, if somebody ever hits you first, you better finish the fight, right?
Yeah.
But don't ever hit anybody first.
That was always a rule.
Yeah.
Well, now you get sued.
Exactly. And that's, I think what I think it is I think people need a whole lot more punches in the nose now.
Oh, there's a lot of people who need those.
I think if we started punching people in the nose again, you would solve a lot of these problems in the country that we have going on, right? Just, you want to protest, right in the nose, and it's done. It's over with.
Well, we also didn't have all the cameras and, on your phone and everywhere else. That's changed the game a little bit too.
Yeah. If Lance dressed up like Danny, maybe his wife would listen to him. No. That is not the case in my household. I actually had this conversation.
She wouldn't listen to him anyway.
I had this conversation with my wife yesterday. I told her no on something she wanted to do. And she goes, "I'm sorry. I think I misunderstood what you said." "You meant, yes, you can do that, right?" And I was like, "Yes, honey, that's what I meant." So, yeah.
She's like, "I didn't know you learned a foreign language. What just happened
here?" She goes, "I'm going to do what I want to do." I'm like, "Okay."
All right, love you. See you.
Exactly. So no, I could wear a tuxedo, and she is not going to listen to what I have to say. Totally true story. Totally true story. I went to lunch the other day with my wife, and we're sitting in Jason's Deli having lunch, and a gentleman came up and says, "Hey, I listen to you all the time on the radio show. Love your stuff." And he's just going on and on, kind of gushing, and my wife's just listening to all this. And and he looked, and so this guy looks at my wife, and my wife says, well, why do you think I'll let him manage my money? My wife did not let me manage her money until last year. We've been married for 15 years. Why? Because she doesn't think I know anything. She's, now if Danny, her whole thing in life is if something happens to me, I just call Danny. That's all she knows. So she trusts Danny.
Yeah, that's great.
Right?
Well,
me? No. I do not know what I'm doing, but she trusts Danny.
Well, I think I told you, I've got a buddy who created a fake Facebook profile and made it look like this person knew all these people. But if he wanted his wife to do something, he would just go out and have this person say it. And evidently it works. But, I've noticed too that I could make sure to drop a hint around one of Michelle's girlfriends and she'd be like, oh yeah. And then I'd say, been telling her this for a while. And then she hears it from one of them and it's like the most genius thing you've ever heard. And I'm like, yep, that's great.
Yep.
I've been telling you that, but
awesome.
I just bite my tongue.
I know. That's the way it is.
It is.
It is interesting just to wrap up the show here. We've only got a couple minutes. The point, kind of the big point today is that there is a lot of speculative risk returning to the markets right now. That doesn't mean, and again, talked about this before, but, I'm starting to see kind of the media, I don't want to say the media because it's not all the media, but people, right? Influencers, et cetera, out in the internet world, really becoming much more divided. There is the uber bullish camp, markets are going to the moon, and then there's everything's about to fall apart and blow up, and there's going to be a 50% massive sell-off in the markets, et cetera. There's no evidence of either of those right now. The risk to the markets currently is that we are very extended, getting very exuberant, but there's no real underlying economic underpinning that suggests that we're going to have this massive sell-off in the markets due to some financial calamity. There's also no real support for the markets to go from here 40% higher. Valuations are extended, earnings are slowing down, those type of things. Now, there's a lot of expectations that earnings are going to start to grow massively in the third and fourth quarter of this year, and then into next year, we'll be looking at year-over-year rates of change in earnings growth of 16%. That only happens if you get much stronger economic growth. So if you can make the case for an economic resurgence where the economy is growing at 3 or 4% annualized on a real basis, then maybe we can achieve those goals. But again, I think we're stuck in this middle. And again, our thesis at the beginning of this year was a year of lower returns with more volatility. And we have certainly seen that to date. Now, doesn't mean we're going to finish the year that way, but I do think, kind of looking at the data, that the risk of another pullback here in the market is much more probable in the next 3 months or so than a rally to substantially higher highs. Another 10% rally in the market.
But you're not talking about falling off a cliff. You're talking about normal volatility.
3 to 5% correction, right? Nothing big. But even a 5% correction after the rally we've had is going to feel massive.
All right, so I want you and Mike tomorrow to talk about this. So if the market's expecting 16% growth year over year, but yet they're expecting cuts, it's going to have to be really strategic, right?
Correct.
Okay.
All right. Wraps up the show for today. Thank you very much. See you back here tomorrow with Michael Leibowitz. We will talk about CPI, PPI, inflation, the Fed rate cut potential, all that tomorrow with Michael Leibowitz. Get by the website, realinvestmentadvice.com. Subscribe at X as well as Substack at Lance Roberts to get all of our latest articles, posts, and more. And make sure and like and subscribe to the channel. It certainly helps us out a lot. We appreciate it. See you back here tomorrow.